the responsibility of monitoring the borrower, that's point number 4. In any model, I mean old-fashioned banking model, we used to teach in class that banks have a function because they are, the function is delegated monitoring. Namely, when you deposit in a bank, you delegate the monitoring function to the bank. Monitoring who? The borrower. Well, with asset-backed securities, which by the way are an interesting way to spread risk, we forgot the function of monitoring the borrower. Who's monitoring the borrower? And the answer was the rating agencies, and indeed it didn't work. Why then the model of, instead of lending and monitoring, we went to the model of originating, lending, backing, and selling the loans. And again, were all incentives built into regulation. One has been mentioned again and again. I mean, you have to save on capital ratios. So instead of lending, basically you originate your loan and you push it outside the balance sheet because you save capital. Even worse, accounting rules. If you lend, if you are a bank, you lend money, you book the margin every year. A mortgage, it takes 30 years to get the margin spread. If you just originate, pack, and sell, you do the front loading of all the fees. So obviously, the longer the package of the asset-backed security, the higher the possibility of front loading profits. And by the way, the regulation allowed actually encourage the adoption, the general adoption of the rating model. Namely, you assess probability because capital requirements of the security industry and the banking industry are based on the same model of the rating agencies, which we know they don't work. And again, in the presentation, we talk about risk-weighted asset. What are the risk model? Well, the risk model are the risk model that long-term capital management used to have, and we know very well they are statistically flawed, and they don't work because they are not built and supposed to deal with extreme values. I mean, we knew that perfectly because in 1998, long-term capital management defaulted on a liquidity crisis with the most sophisticated credit risk model. The same models not only have been accepted, but the banks were allowed to use the risk models, and last point, obliged to use them. Last point, the responsibility for the lack of transparency. And that's, I blame entirely the stock market regulators. We don't know what really the assets quality or what is in the balance sheet of the banks. Well, I haven't seen any stock market regulator asking hard questions to banks. Why? I don't know. Or I've seen recently stock market regulator prohibiting short sale, and much of these short sales are naked. Namely, you short sell without buying the stock and without posting margin. I thought it was supposed to be illegal. Actually, it was supposed to be market manipulation. And I realized it was perfectly tolerated. And only 2 weeks ago, I realized that the practice that is illegal was absolutely tolerated.